Good evening. This is Ken Long at Tortoise Capital. And here are some ways that we've looked at in our chat room, our trading laboratory, to improve the mechanical swing systems that are the basis for our intermediate term strategies. These are all things that you can look at developing individually or collectively. First, considering market condition, and we have a number of different ways that we can do that to determine if the market is still in a position to help or to hinder the continued follow through of your system. So if you're holding a gain and there are reasons why that target might keep going, you could then take a look at the market conditions, seeing if that's going to hinder or help. You might also consider the current performance against various historical performances to see just how exceptional that current move is, and then use that as a basis of judging if there's more reasonably available in the move, or if you've already got an above average return, maybe this is enough and you want to preserve the gain. So it's a question of whether or not you're at the tipping point of aiming to gather more opportunity or preserving the gains that you've already made. Third, you might consider targets from either the ETF2 or the blended monthly rebalancing tables of performance to look for candidates for relative strength and see if any of those longer term indicators suggest some short term swing gains. You might also look at that as a way to evaluate the current gains that you hold, although I prefer the historical performance method. In a separate presentation, I discuss at length the idea of the trade index analysis. We worked through a couple of these examples at our different workshops with live portfolios, and this has always proven to be a very popular approach and a powerful way of looking for opportunities to refine your particular swing systems. And so I'll cover that in a separate video. When considering market conditions, these are the ways that I look at. The first is the market classification system, in which I look in two dimensions. Is it a bull, sideways, or bear market? And in that case, I'm looking at price with respect to the 200-day moving average. And then I'm looking at the volatility. Is it volatile? Is it normal? Or is it quiet? And I look at this every day when I compute my my daily report, and I'll show you where that is in just a second. So when I look at my daily report, I'm going to look for market classification, market conditions here on page 2, the summary. And let me zoom this up. So in the upper left-hand corner, as of October 8th, 2017, at the time of this recording, a couple things. We're in bullish conditions and we're in quiet. So we're in bull quiet. It's bullish because price is more than 2% above the 200-day moving average. If it was within plus or minus 2%, it would be sideways. If it was more than 2% below the 200-day moving average, then we would be bearish. But because price is above, we would be bullish. And then compared to the last 100 days of volatility, as measured by ATR percentage, this is among the 1/6 most quiet, and so therefore the combination gives us bullish and quiet conditions. And then while we're here, I'm looking at NDX 260. So on an annual basis with NDX 260, it's similar to Williams %R. We are overbought. We're in the top 99th percentile, or the top 1%, if you will, of the annual trading range. And then on a 10-day basis, it closed in the top 5% at 95. So in both of those cases, we have a market that is overbought long-term and short-term, and it's bullish quiet. Now, bullish quiet is green. That means it's favorable to hold overnight. So this is one of those conditions in which I would consider adding, either adding to the position or keeping the position open, because the tendency is to continue. I also look at some of these other indicators. Let me try zooming that in for you a little better. I look at all of these. It's too long to cover each one in detail, but all of these elements of the market mosaic give me insights into various market conditions. I mentioned the risk Z, and this is the 30 period moving average of the VIX divided by the 10 period, and then we take that number and look at the last 180 days and of course last 20 years, and then compute the Z-score, and it gives us a relative volatility indicator. So anything above the zero line is favorable, and when the histogram is rising, that is favorable. In this case, the risk Z was as high as 1.5 and is starting to decline. This is an indication that we are late in the season for swing trades, and on a volatility basis, I'm concerned about sudden sharp sell-offs when the market has been this favorable for that long. And so despite the bullish quiet, I would take a look at the overbought conditions on a 10-day and this declining risk Z and say, you know what, my swing trades are probably pretty good. I want to take at least a partial win, or at least make sure my stops are carefully in place and that I have a way to hedge intraday to protect those open profits. So any of those indications or courses of action are legitimate given these current market conditions. And then it just is a matter of how active you want to be in the market with end-of-day data to make those decisions. So those are the first three categories. The MACD histogram 1035 technique I have covered in a separate video, so I'm not going to go further into that one. So next up, I want to take a look at historical performances. And so this is based on my work on holding X days, and these are the symbols that I had on my short-term target list. And I'm looking at 4 different time frames over the last 5 years: 40 days, 20 days, 10 days, and in 5 days. And so I've gone back and looked at each of the possible 40-day holding periods and found the maximum performance, the minimum performance, the average, and then found the standard deviation. That lets me compute the plus and minus 1 standard deviation. So over the last 5 years, the average 40-day holding period in SPY is 2.39%, and in the NASDAQ it's 3.29%, and so on. The current holding, as of the 9th of October, it was 4.54%. So you can see it's been a slightly better than average 40-day holding period in the S&P. How much better? Well, when you compute the Z-score, it's a 0.4 standard deviations above average. And so that means it's better than average, but not abnormally better. So it's not overheated on a 40-day basis. It would have to be, in fact, average plus 1 SD, or 7.75%. If it was more than 7.75% over the last 40 days, I could have reason to believe that the engine is overheating and this is a really unusual set of gains, but in this case it isn't. So on that basis, if I were holding a swing and it was 40 days old, I would say, well, this is good but not great, and not certainly not overblown. So I would continue to hold it on that basis. Similarly, I can look at the 20-day holdings, the 10-day holdings, and the 5-day holdings, and I just find the one that is closest to the length of time in the trade that I currently am, and consult the Z-scores to determine if I have anything that's overheated or not. If we just take a look at the quick Z-scores over the last 40 days, the largest one right now is small caps at 0.98, and so they're up almost 10%, whereas the S&P is up 4.5%. The small caps are up twice that amount, and the Z-score at 0.98 puts it right at the boundary of an exceptional move. So the small cap profits that I have right now, I want to make sure that I'm preserving. I also want to drill down and be prepared to trade that one on momentum days, believing that everybody is recognizing that the small caps are outperforming, and so there may be some more interest and some more momentum. So on the basis of historical performance, I would be willing to evaluate my small cap trade frame in that sense. Finally, we'll take a look at considering targets from the ETF and the BMR tables. And so, off my daily report and the weekend report, I look at first the blended monthly rebalancing tables. This just happens to be the ETF 13 for display purposes and discussion purposes. But I have these ranked based on the blended returns. And so the two best in the green on the blend are Latin America and emerging markets. Now you'll notice that both of them have slightly underperformed over 1 month because it's in the yellow. So it would go green, white, yellow, and red. So green, white, yellow, and red. That's based on looking at the standard deviation, the average performance here on the 13 ETF peer group. So the Latin American emerging markets have blended returns of 12 and 16%, whereas the three laggards are down around 3, 2, and 1%. Real estate, Australia, and the treasuries. And so on a blended 3 and 6 month percentage, that's how they get scored. And that's the way that we evaluate longer term holdings in ETF2. In blended monthly rebalancing. But recently I have added the 1 month and the 1 week performances to see if there are some swing trade opportunities. And now the things that really stand out at me are these. And that is that Latin America is starting to underperform a little bit compared to emerging markets and technology. In fact, this new outperformance here in technology has me interested in that sector because on the one hand, it's above average, but not exceptionally so on 1 month, 3 month, and 6 months. But on the 1 week basis, it's the second best performer. And so this may be evidence of new money coming into technology and the beginning of a new wave of longer term momentum. At the same time, there was in the mid-cap spiders, despite being very much below average here on the longer term, it's had a great 1 month, and although it's stalling a little bit this week, this may be the sign of a reversion back to the U.S. U.S. mid-caps have been horrible, and so there may be an opportunity beginning to emerge. And this is on the basis of looking at 1 month, or 1 week, 1 month, 3 months, and 6 month performances. And I do this for multiple portfolio sets in blended monthly rebalancing, so I can get a wider and deeper view into different market sectors using ETFs as my guides. In a similar fashion, but using a different strategy for comparing relative strength and momentum, the ETF2 category, and this is one that looks deeply into the ETFs and the Dow 30. And I look at things on the basis of strength first, and that's strength over the last 3 months. And well, actually, this is a 3 month and 6 month blend, similar to the one that produces this performance. And then consistency is a 10-week moving average of strength. And so the color codes green, white, yellow, and red are constructed in the same way as they are up here for consistency. And so what I look for are items that are in the green on strength and white on consistency. This is one that has been above average over the last 10 weeks, but only has recently stepped up into the green and become exceptionally outperforming. And so on that basis, a green and a white is an indication that we are starting to see longer term momentum come into that sector, and there may be some more room for gains. And in fact, the ETF2 strategy focuses on taking long-term positions in ones that are green and green. And so when it's green and white, this may be a chance to front run, in this case, biotech, which may grow up to become green and green. And so China and U.S. home construction and emerging markets are both in that category. Now, similarly, the European Financial Sector Fund showing white and green is the opposite case. This is one that's been outperforming exceptionally over the last 10 weeks, but this week dipped down into the white. And so this may be one where it's already seen the top of the hill and is starting to decay a little bit in terms of momentum. And so that would be one where I would be looking to ensure I preserve my profits. And so similarly, the MSCI EMU index and South Korea are both in those categories. Now, in the case of Brazil, with white and yellow, This is almost like green and white, but one quantum level lower. This is now what was below average on the last 10 weeks is now above average, but not exceptionally so. So there's room for Brazil to continue to make gains in this strategy. So that's what I mean by looking at ETF2 and the BMR candidates, which are longer term holding systems, but they will often give insights into emerging trends that may not be easily seen on just by looking at individual charts. By comparing it to other members of their peer group, there are ways that you can make improvements to your target markets for swing trades. So that's a strategy that we've been using with some success, and it's based on asset allocation in the global markets. So just a quick review then. We've taken a look at ways to improve performance of mechanical swing systems by putting in a little bit extra research, considering market conditions in various ways, looking at current performance versus historical performance, looking for candidates in ETF2 and the BMR as ways to finding and then tapping into longer term momentum, and then under separate briefings, looking at trade index analysis as a way to improve the particular rule sets that you're interested in. So, Ken Long at Tortoise Capital, thanks so much for your kind attention. Keep your risk measured and your powder dry.